as we welcome one former student, I also want to take this opportunity to thank all of our students who are volunteering today and helping us and who've been helping us at the Passaro Center, and also Professor Lee Pinkowitz, who is our Associate Director for Student Engagement. There he is. Please, if you haven't seen Mr. Pinkowitz, do say hello to him. Yes. Well, it is such a pleasure to welcome you back here, Chair Benham, a Georgetown alum, and I'm going to ask him about his Georgetown experiences. But I also remember when you became commissioner of the CFTC, I think your very first speech you gave here at the center in November 2017.
Yeah.
Right? So welcome back. And I just want to start with, tell us a little bit about your experiences at Georgetown. What did you major in? How did you end up becoming the chair of the CFTC?
Well, Rena, first of all, thank you. It's awesome to be back here. It's every time I come back on campus, it's a special feeling, which I know alumni who I'm sure in the audience feel, and current students, you'll appreciate that as you get older and graduate and leave the hilltop and come back. But yeah, I became chair in 2017, and just reflecting on those times here, I was an English major, had a lot of great professors in the English department. I was an econ minor, and the one thing that I think about a lot in my time here, especially with where I've gone in my professional career, both working in finance, working in law, working on Capitol Hill, and then at the CFTC, is go to Georgetown. I should have majored in government or history or poli-sci and whatnot, but every major is special. There are amazing professors here across the board, and that interdisciplinary opportunity it's a tremendous thing. And I think for me, being here in the 90s and coming back to campus, it doesn't look like what it used to, right? So for those of you who are new, you don't realize that, but this building and many of the other buildings, just a parking lot. So it's a special place. It's got a special place in my heart. And the one thing I will say is the community of Georgetown alum is extremely strong. It's almost dysfunctional, actually. The group of friends I have from my class, that we're still so tight, we're so close knit, and we are very fortunate to have this place as the anchor for our friendships, our families, and everything that we care about in our lives.
Okay, so we have a lot of ground to cover here. I'll start with a broad question. What are you expecting happening at the CFTC in the next 4 to 6 months, in a year? What's high on the agenda?
Yeah, so it actually makes me think, Rena, about the first speech I gave and coming here in November of 17, nearly 5 years, which is remarkable to think about. And so much at that moment in time, as the discussion we have and the speech I gave was focused on Dodd-Frank and the global financial crisis, and where the CFTC and the US regulators were, 7 years later, after the bill had passed, but certainly years of implementation. And from a CFTC's perspective, there were a number of rules, major Dodd-Frank rules, capital requirements, position limits, which is a big deal in the commodity market space, de minimis standards for swap dealers, which were new entrants into the regulatory regime. And these were issues that I was thinking about at that time, because we were at, and I use this phrase a lot in the speech, an inflection point where we were either going to push forward and finish these rules and finalize this regulatory structure that had been built by the G20 in 2009 after the financial crisis, or we were going to take a step back and we were going to let inertia sort of get in the way of doing what we knew was right and what we knew we needed to do to prevent another crisis from happening. So 4 years later, all of those rules are done. I opposed some, supported others, but by and large, I think we're in a good place from a markets perspective, from a CFTC regulatory perspective, and I don't foresee any major rulemaking happening at the agency. That said, there's a lot going on in markets right now, and as I've thought about what I'm going to do and how I'm going to approach the next few years, a few things come into mind. Data Data is a huge part of market structure and market environments right now. And I think as a regulator, we feel always a step or two behind. We need to modernize our data infrastructure, start to think about machine learning and AI and data analytics as a tool for surveillance and enforcement and market oversight. I think this is going to make us much more efficient and a better cop on the beat for markets. So it's going to,
Rostin, just to ask, when you say data, is it more data collection from member firms and exchanges?
we collect all the data we need. We're
Okay.
very careful about that.
Yeah.
It's the way we process the data. It's the way we analyze the data. It's the way we filter the data. And I think we have to move from really old technology to new technology. And as firms, including financial firms, are moving to this space, obviously transitioning to the cloud and using machine learning and data analytics as a tool for market intelligence. And we need to be there with the market and our stakeholders to ensure that we're doing our job and we're fulfilling our mandate. I would say a few other things that are extremely important right now. We're having a huge influx of new market participants. This intersection of digital assets and crypto is obviously changing the way institutional and incumbent firms are managing their business and their books, but it's also bringing in new firms, native crypto firms into our space, wanting to do a lot of different things. It's interesting to think about 2020 and the pandemic, and obviously on the equity side of the market, we remember the meme stock movement, which is still going on to an extent, but we saw that in our own markets. There is a disruption that's bringing down barriers to access for market participants. Many of you students here know, you can just hop on your phone, download an app and start participating in markets. I remember, no joke, being in Darnell with a dial-up trying to log on to a Schwab account in 1998. And that might not mean a lot to many of you, but literally dial up with my computer in Darnell Hall, which was like revolutionary technology at the time. So that's another thing we're thinking about. And combined with that, we're seeing prediction markets evolve and mature prediction markets. Again, a little bit of product of technology and disruption, but raising a lot of novel legal issues and policy issues and risk issues. So those are a few of the ideas that we're thinking about. And I'll end with this is we are always, certainly as long as I'm chair, looking at the rule set and making sure the rules that we have, that we've implemented, are fit for purpose, right? So I talked about position limits, I talked about capital rules, our data rules, our threshold levels for registrants. Markets are always evolving, markets are always shifting because of technology, because of geopolitics, because of other issues. We have to make sure every day that our rules are fit for purpose and that we're fulfilling our mandate and our requirements from Congress. And in an environment where you have huge geopolitical risks, having direct impacts on commodity markets, impacting shocks, volatility, which I've spoken a lot with my colleagues during this IMF World Bank Week, we have a huge responsibility at the CFTC to make sure our infrastructure, the exchanges, the clearinghouses, most notably, are resilient, are doing their jobs, are ensuring that market users and end users are able to hedge and manage risk. But ultimately, we're doing our job as a supervisor to prevent financial stability issues and above all else, protect market resiliency.
So you started to talk about crypto and digital assets. Do you think there's confusion about what is a token, what is the security, what is a commodity? There are some regulators who say, well, it's pretty clear and there is no room for confusion. But the last few hours, I've just been hearing again and again that there is confusion. How do you think about it?
Well, there are a lot of different questions within, I think, the question you asked. And I think there's a lot that we have to dig into. I think right now, as regulators, we've had to rely on precedent and law that is fit for a very different model and very different financial instruments. Not suggesting that it doesn't work or can't work, but from my standpoint, and we should talk about this, we've had at least 2 federal courts say Bitcoin is a commodity. I've suggested myself that I believe Ether is a commodity. There are a number of other tokens that I believe are commodities, but the right analysis and the appropriate analysis needs to happen, legal analysis needs to happen in order to compartmentalize where these tokens fit. I think the larger question is, what can we do as a market regulatory apparatus to ensure customer protections, to ensure market resiliency. And as I see this market mature, over the past couple of years, but certainly going back to 2009, and it's been remarkable, right? In 2017, I was in this building talking about Dodd-Frank, right? And a few months later, the CFTC listed its first registered, Bitcoin futures contracts on 2 of our registered exchanges. And that was a huge moment that forced us to think about a lot of policy and legal questions that we had otherwise not thought about. And I think there were moments where at that moment, the commission at the time, is this going to last? What's going to happen with these contracts? Will there be liquidity and open interest sufficient to maintain the contract? And here we are 5 years later, multiple trading platforms exist now that list these commodities. And as I'm sure many of you have heard, I've been calling on Congress to provide us more authority to regulate the cash market, which largely remains unregulated. And this is a partnership that we're all involved in. But figuring out these questions, these hard legal questions, I think in part are solvable, but in many respects, more work needs to be done.
So help us understand what authority do you have right now? What do you need from Congress in the form of new legislation? And what clarity would that end up providing?
Yeah, so to state the obvious, we're a derivatives regulator. We only regulate derivatives financial instruments. We do not have authority over cash markets, spot markets. The limited authority we have to sort of peer into or to look into cash markets is related to fraud or manipulation. And this is a mechanism, a policy decision that was driven around market protections and customer protections. And you can think about very logically why Congress would have provided this authority. If you have manipulation in a wheat contract or a crude oil contract or a precious metal contract, that manipulated price will be reflected in the futures contract or the contract that we regulate. So this is a very limited, but also very powerful tool that we have. So over the past 7 or 8 years, the CFTC has brought, I think at this point, about 62 enforcement cases in the crypto digital asset space, from trading platforms to stablecoin issuers, to intermediaries, to individuals and institutions just executing very classic Ponzi schemes, pump and dump schemes, pyramid schemes, some as large as $1.9 billion, some in a few $100,000. And the important thing, and this is a nice dovetail to what I'm asking for and why I'm asking for it, is every single one of those enforcement actions has been driven by customer complaints or whistleblowers or tips that we have received. None of it is driven by surveillance tools or market oversight tools that we retain in traditionally regulated markets. So I've said this to Congress before, you can imagine 60 cases, some very large. It's probably the tip of the iceberg, given that it's really all just relying on people coming to us and saying, hey, CFTC, you should take a look at this. We think there's fraud or manipulation in the space. So what I've called for is cash market authority in the digital asset commodity space. And that would provide us legislative authority over cash markets. These would be the trading platforms, the intermediaries or the broker-dealer types, the custodians, potentially the data repositories, and those core infrastructure components of markets. Not much different than derivatives markets, not much different than securities markets. I often say markets are markets, and the financial assets, although very unique in many respects, when you think about the infrastructure about a market, what you want from a pre-trade perspective, transparency, equal access for all market participants. When you think about the order book, you want a transparent order book with bids and offers, and you want post-trade transparency. You want reporting and data collection. And of course, you want custody and settlement to operate smoothly and efficiently and quickly. So those components are really, it's not very novel what we're trying to accomplish. The underlying digital asset, obviously, is a very new technology, but that's been the authority I'm calling for. It is certainly a change for the CFTC, but given that we are, in my view, a gold standard of a market regulator, and as I said, one that's been involved in the digital asset space for the better part of 6 or 7 years, We have built a really unique expertise in the space. And I think we're well positioned to be the cash market regulator over the commodity digital asset space.
So we're going to hear in a little bit from Senators Lummis and Gillibrand. And so we have right now, there are two bills floating around in Congress, and probably there are going to be more that will come. Are these bills missing something? Are there some products that are not getting covered?
You know, I want to give a lot of credit to Senator Lummis and Gillibrand. They've been very forward thinking and taken a leadership role in the space. But I'm going to focus. There's another bill in the Senate. It's the Stabenow-Boozman bill. There have been a number of co-sponsors, and we worked very closely in providing technical assistance to that committee. And that bill is very limited in scope. And I'll use as a sort of comparison, the Lummis-Gillibrand bill is very broad in scope. It deals with most components of the digital asset space, from tax issues to settlement issues, stablecoin issues, and market issues. The Stabenow-Boozman bill is very limited to just market regulation and markets issues. And in providing technical assistance and in sort of seeing what the vision of Senator Stabenow and Boozman was, I think we did, and they did a very good job in ensuring proactively the definition of digital asset is defined well, but also the exceptions are created in a very creative but prescriptive way. Namely, one of the biggest exceptions is we would not oversee securities or digital asset securities, and we would not oversee essentially a CBDC or a central bank digital currency that's backed by the full faith and credit of the Treasury. So in my mind, it's quite exhaustive, and it's a nice combination of creating guardrails that gives us steer and a direction of what we need to do. But as many of you know, in the sort of divisions between the legislative branch and the executive branch, not being too prescriptive, which enables us the flexibility to write rules that are adaptable over time, as we would imagine this technology changing and evolving and enabling to keep up with markets as they move. And I think, Rena, to your point, seeing and understanding and appreciating that the assets themselves may change and the technology driving the sort of characteristics of the asset, we would want at the executive branch level to retain that authority to adapt and to change with the technology.
I see. Yeah. So the market participants are quite frustrated, right? It is complex. These are new products. It takes time to figure out what's the appropriate regulation. You don't want to get it wrong. But it's new technology. It's moving very fast. What is the timeline here?
Well, from my perspective, I like I said earlier, this is a call for action. We need new authority. Right now, the markets are largely unregulated. And as a regulator, my number one concerns and issues and responsibilities are customer protections, market resiliency, and ultimately, depending on the size of the market, financial stability. And I don't think I have the tools to fulfill that mandate and to fulfill that responsibility. We have been working closely with Congress. Obviously, the fact that Senator Gillibrand and Lummis are speaking, and you see other bills, including the Stabenow-Boozman bill. This is the leadership we need. Credit to President Biden for putting out the executive order, which has led to a number of reports from multiple agencies, including the CFTC. And I think putting the executive branch and the U.S. government in a good position to execute on this mandate and this plan. So as we look forward to the next couple of months, I think it's possible we might see some legislation, but my hope is that by next year, 2023, the sort of fulfillment of this project in many respects is complete, and that would give us the opportunity at the CFTC to start writing rules and to bring this market into the regulatory fold, and then ultimately, to your point, create that clarity and that certainty for market participants, both from a technology standpoint and also certainly from a financial institutional standpoint. I often say this, it's my responsibility, as I said, is customer protections and market resiliency, but it's, I engage very much with the marketplace, the technologists, the entrepreneurs, the innovators, and then obviously the traditional incumbent financial institutions. As you said, they're looking for this, they're looking for that certainty, and we have to address that. We have to sort of meet that moment and step up, because there's so many different components, not only from a market resiliency standpoint, but from an innovation standpoint, from a national security standpoint, as we're seeing many of our allies, but folks across the world moving forward rather quickly in the space.
It was interesting today morning, Chair Gensler said the CFTC should get more authority over stable coins. What are you expecting there?
I'm not sure that was a correct quote. I'd be surprised. I'd be surprised if it was.
Not the securities, the underlying.
Yeah. So
Not
the
stable.
stable coin issue has been a separate issue in many respects because the president's working group, which is I think it's a savings and loan era body. It's a very useful body within the U.S. government of the major market regulators, SEC, CFTC, and the Fed and Treasury. And we've been doing a lot of work on stable coins, and this has been a priority for Secretary Yellen and Chair Powell. You can imagine why, right? The fiat-backed stable coins have proliferated, and I think that's an understatement, where you have a lot of fiat parked in money market funds, in fixed income instruments, and potentially in unknown places, right? And if you have a run on a stable coin that's so large, this could sort of spur runs in different areas of the financial system, including money market funds, treasuries, open-ended funds. And as we experienced 2008 and then 2020, these are the issues that I think financial regulators think about in terms of price dislocations and liquidity that we need to address. So this was a priority. We put out a report, we recommended and requested legislation, and Chairman Gensler and I worked very closely together on this, and we understand both of us need to retain enforcement authority in the stable coin space, but we may differ a little bit on the authority around the stable coins themselves and the issuers. But I do know that Secretary Yellen and Chair Powell and myself included are working very hard to have legislation around the stablecoin issuers as bank regulated entities, which I don't think is anything that's not been in the public sphere. So I think we continue to work towards getting legislation out of Congress to protect that space. And as we remember, in April and May of last year, some of these bankruptcies and failures in the digital asset space occurred in the algorithmic stablecoin space, but certainly had knock-on effects in the crypto market, but also fiat-backed stablecoin issues as well. So you see that interconnectedness that we see in all financial markets, but something that we're trying to get ahead of as soon as possible so that we prevent the next crisis.
But you have an application pending from FTX. Can you comment anything in terms of where it is and how you're thinking about it?
I can't comment on the timing, but on the how I'm thinking about this, and I've talked about this a bit, and I think it's an interesting discussion. This was an application that came in a little less than a year ago, and it's a request for non-intermediation of leveraged digital futures. Particularly FTX owns an entity that has a BTC and ETH contract, fully collateralized now, but they want to go to leverage contracts, but non-intermediated. Non-intermediated futures would be a significant deal. It's a significant shift. But they have come to the CFTC and had a proposal. They want to amend their current application. And I thought all along that as we do with all our constituency or all our registrants, which they are one, we have to be fair and equitable. We have to engage and discuss the issue, and we have to see what their proposal is, and we have to work through that process. Understanding the novelty of the issue when we received it, I thought, okay, we can move forward with this in terms of engagement, but we have to be very transparent because it is such a big issue, and it presents such unique risk issues to markets that are potentially have contagion to other parts of the market. There are unique and novel legal issues, and then of course, unique and novel policy issues. So I put a consultation document out in March of 2022, which we received, I think, thousands of comments in response, some very supportive, some very against. And then we had a very productive roundtable in middle of May of 2022 with a very diverse group of market participants and academics and other public interest groups, moderated by a gentleman from the Chicago Federal Reserve, which I thought went very well. And the takeaway in my mind, although there were certainly folks on the polar ends in terms of positioning, was this is a unique technology. this is a unique intersection of the crypto space and traditional finance, which is what I really think is so fascinating, right? We have these silos being built in terms of traditional finance and crypto and digital assets, but you're naturally going to see that synergy form between the two, where you have conversations with some individuals from the crypto digital asset space. They come into the traditional market space and they're just a bit puzzled. You know, they're like, why do you do it this way? We have a way that's more efficient, where we can have trade execution that's quicker, with better pricing, and we can have settlement and custody in a much better manner. And that's where I think we have to learn from each other collectively, and not necessarily take everything to heart, but this is an evolution in innovation. This is an evolution in disruption and market evolution, right? And we dealt with this most notably in the 1990s into the new century with markets moving from floor trading. I'm sure you're all familiar with the historic commodity market venues across the country in Chicago and Kansas City and New York, with pit traders making call signs that we probably all don't know what they are. But you could imagine if you went to those individuals in the 1990s and said, hey, you're not going to be around in about a decade or two. I'm not sure how you would have left that trading floor. But here we are. We're in an electronic environment, mostly driven by algorithms. And I think this is potentially, and I emphasize the potential, another phase in the evolution of market structure, innovation, and disruption. And I think it's incumbent on regulators to be open-minded, cautious, deliberate, and inclusive, so that we have a conversation that includes everyone's points of view.
So I'm going to shift topics a little bit, and let's talk about climate.
Yep.
What is the role of the derivatives markets in pricing and price discovery in the whole ESG discussion?
Yeah, I mean, you know, this is another issue that has been so sort of dear to my heart for a number of years. I've been thinking about climate going back to 2018 and 2019. Was very fortunate to put together a report back in 2020 on the relationship between climate change and financial market risk. And then as I became chair, it just started to really make me think about what can we do from a CFTC perspective. You know, we are a commodity market regulator. We oversee agricultural markets, metals markets, energy markets, and these are all core elements of the energy transition that we're trying to accomplish. And as you said, Rena, price discovery is a key component of every marketplace, cash market and spot marketplace that exists in the world. So we're starting to see a lot of innovation. We're starting to see a lot of product development in the pure ESG space, so that clients and customers can have access to these products, but also starting to see some very unique opportunities as I think large corporates and sovereigns and individuals are starting to try to move the transition to a carbon-free economy in a quicker, swifter, a more mitigated way. So carbon offset markets come to mind, and we are seeing some innovation in that space in our markets. Several listed futures on carbon, voluntary carbon markets listed. Also, just a conversation that I've thought very deeply about is what resiliency and what issues do we need to think about from a regulatory perspective to protect markets. I mentioned this, I think, a few days ago at a different conference, but you'll all recall a few years ago when there was a winter storm, Ida, I think, in Texas. I think that was right.
Yeah.
And Texas really froze over, and Texas has a very unique power grid and energy market, and there are listed futures contracts on ERCOT, which is the power grid for Texas, on CFTC regulated exchanges, and those contracts had settled. So payment had been made between two counterparties. And then a few days later, as that freeze continued and consumers faced a huge spike in energy prices, we started to hear rumors and then some discussions by public officials in Texas that they wanted to reprice power. So you can imagine if they had repriced power to lower costs for consumers and their constituency, which you can appreciate and be empathetic to from a human level, given what was happening. This would have caused massive disruption in financial markets. And think about the faith that we have in financial markets and execution and settlement. And if that's disrupted, then you start to have a lot of fragility and fear in the resiliency of financial markets. So This was not unlike some things we saw earlier in the year in metals markets and nickel. But those are the type of climate events that are happening more frequently and happening in a more extreme way that I think we need to start thinking about from a regulator's standpoint to say, is there something we can do to at least scenario analyze these potential events so that we can be better protected from a regulatory perspective?
In a number of areas, it's quite likely that you're going to get more authority, more responsibility. Are you ready for it? You said you said you're the gold standard as a regulator.
Yeah, I mean, look,
and some describe you as light touch. How would you respond to them?
Well, those who describe us as light touch then just don't know the CFTC. I mean, that's just the bottom line. And I would welcome you to the agency and we can talk about the track record. I'll say this and I looked this up because I testified in the Senate probably a month and a half ago or a month ago. In the past 10 fiscal years, the average penalties assessed through our enforcement division has been on average just over $1.5 billion. In the same period, the 10 past fiscal years, our average budget has been just over $240 million. So you can imagine that return on investment for a group of finance geeks in the audience, right? That's pretty good. And that's pretty good for the taxpayer. And that's what my response is to anyone who says we're a light touch regulator. So we do a great job. We do a great job on the registrants and the markets we regulate. I think this is recognized globally. And I have no doubt, certainly as long as I'm chair, that if we get new authority, we will move swiftly. Something that I've advocated for and asked for in addition to new authority over markets is more resources. And I could say at a minimum, the Stabenow-Boozman bill does include a user fee mechanism, which is not unique to financial regulators, but it would be unique to us at the CFTC. But that would certainly provide a way for us to raise revenue so that we can hire the right people, technologists, market specialists, enforcement experts, and then also build out our hardware and software infrastructure so that we can monitor these very unique markets. So we're ready for it.
Perfect. And on that tone, any quick, a few questions for Chair Behnam here? Please come on up.
Could you elaborate on that user fee mechanism? What is that?
Sure, it's a means for the agency to assess a fee on essentially our registrants. Again, this is not unique to regulators, but if we had XYZ trading platform that was a registered trading platform with the CFTC based on an understanding and an appropriation from Congress, we would be able to assess a fee on that registrant as a means to cover expenses for the service that we provide to that registrant. So that could apply to a trading platform, a broker-dealer, a custodian, or any other participant that's registered with us.
And just to follow up on that and what you said earlier, what are the resources that you ideally, if your budget were unlimited, how would you staff up?
Well, we've thought a bit about this and, thinking about the landscape of the digital asset market, we'd have to get individuals to focus on the digital platforms themselves, the trading venues. The custodians would be obviously a very difficult issue, raising a lot of novel issues about security and cybersecurity, given the digital asset that the custodians are holding. The intermediaries, again, something we're familiar with. And then the technology infrastructure. And I've put up together some numbers, I think, and I know this will be hard for me to say, don't quote me on this, but we put together some analysis. We're working through it, but we're certainly not going to go to Congress without a very defensible data-driven request in terms of the money we need in order to hire the right number of personnel with the right number of experts so that we can provide the service that Congress is asking of us.
Yeah. Well.
Good afternoon. I'm Rahul, also an alum. So two very interrelated questions. The first one is, you've talked about the attributes of the RFIA, the first Senator Loomis bill, and then the DCCPA, and there are a number of others. Which do you think is more innovator and investor friendly, if you can comment on that? And second, sort of interrelated is, do you put a time value to legislation? What I mean is, do you buy into the thesis that we're losing ground because we're waiting to get the answer right?
Yeah, those are two great questions, and I'll somewhat answer your first question, dance around it a little bit, but we have the best capital market. The United States has the best capital markets and derivatives markets in the world because of the regulations we have. And I know they're not perfect, but it is clear, enforceable rules that are enforced by the rule of law, holding bad actors accountable. And I think that's why large institutions and small retail participants trust our markets and the system that has been built around them for decades. I don't think that theory is misapplied to this space. So what will happen to the industry if there's a regulatory framework? What will happen to the technologists? My suspicion is, just like capital markets, if you create a venue to raise capital for research and development and innovation, that would probably, I think you could probably draw an analogy in this space where you would have potentially large institutions and retail investors feeling more comfortable to invest in crypto assets, which would then potentially, move the technology in a positive direction. On your second point, on the time value, the thing that worries me the most is every day that goes by that I don't have authority is a day that a customer is at risk of losing money. And our enforcement record speaks to that. And I think as markets continue to be fragmented, as markets continue to move in very volatile ways because of a number of externalities and other issues not related to crypto, we have to collectively be very cognizant of those concerns and those risks. And I think that should really spur all of us to want to move as quick as possible. The race against other countries, I don't buy into that. Again, going back to my earlier point, we are deliberative, we are cautious, we are patient, but we move forward. And as long as we continue at that clip, I think we will retain our sort of predominance from an American US markets perspective. We have that luxury in the US and we built that luxury over decades. So I don't think we need to race to beat a jurisdiction, small or large. We just have to do it right. And as long as we're moving the ball forward, but doing it in a deliberate way, I think in the end, we'll retain that position as the home of the best financial markets in the world.
Thank you. I apologize. We need to get to the senators next. Maybe if
That's
Chair
probably a good
Benham is
decision.
around, he'll answer a few questions on the site there. Please join me in thanking Chair Benham.